Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello and welcome to Pasture to Pen, a bi-weekly series from the EverAg Insights team. Each episode, we bring you news and updates on the cattle markets with the intention of helping cattle producers manage their risk. I am your host, Michael Todd Rowen, coming to you from my home office in the Texas Panhandle. Before we get rolling, let me timestamp this episode. Today is Tuesday, October 3rd, 2023 at 3:10 in the afternoon. Today, I will be flying solo as Trey, my usual co-host, is starting the return trip from his honeymoon. However, I will be joined by the feed fanatic and an EverAg grain and feed risk management advisor, Brandon Weigel. Brandon, welcome to the show.
Thanks for having me, MT. Glad to be here.
Absolutely. We are thrilled to have you here. Leading off the show with weather, we are starting to see some precipitation take form across the Great Plains and move east. As we look at the 5 and 7 day forecast, Texas, Oklahoma, Arkansas, and Missouri are looking at very, very good chances of getting some very much needed rainfall. Currently, drought has been a big issue for most of Texas, New Mexico, Louisiana, and southern Mississippi, as well as for the Pacific Northwest. However, drought conditions look to be easing for the drier parts of Kansas, Nebraska, Iowa, and Minnesota. As Dan and I talked about last week, we are in the PRF sign-up window. PRF insurance is a tool available to producers and ranchers to help manage the risk associated with rainfall and pasture conditions. If you would like more information, please refer to the previous episode on 9/19 and give us a call. Moving to the futures market, cattle futures slipped last week and got hit pretty hard again today. Feeder futures have traded lower in 8 of the last 12 sessions, if you include today's session. Last week, November feeders closed below the 50-day moving average of 256 in 2 separate trading sessions. November feeder futures fell further below that average and closed today at 250.35, with next level support being around the 246.70 mark. Live cattle futures have also traded lower in 8 of the last 12 sessions, including today's, albeit not quite to the magnitude that feeder cattle futures have traded. Last week, December live cattle futures traded below the 20-day moving average of 188 in 2 separate trading sessions. December fats gapped lower today and closed right at their level of support at 185.65, with next level of support being around 183.30. Outside markets are definitely playing a factor here. The Dow was down 500 points, trading to its lowest level since June 1st of this year. The U.S. dollar has posted very strong gains since its July low of 99.20. The gain of $7.62 to 106.82 is definitely going to weigh on commodity exports and make imports a much more attractive option. The recent market moves are a stark reminder that cattle prices are not just susceptible to themselves, and that the cattle complex fits into the greater economic picture. Switching to the cash market, the CME feeder cattle index sits at 252.21 as of 9/29. This is down $1.85 since 9/22 week over week. Nationally, feeder steer and feeder heifer prices are down $3 to $6 since last week. For this week, Oklahoma National's sale yesterday, feeder cattle started the week $2 to $6 lower, while calves are as much as $5 higher. Joplin Regional Stockyard sale also yesterday, feeder cattle prices fell $2 to $9 lower. Live cattle cash prices continue to be strong. Last week, sales in the north were at 184 live, while sales in the south were at 183 live. Look for this north-south spread to continue to narrow or even flip as we head into the winter months. Winter moves supply and preference towards the southern cattle feeders, as southern winters are much more milder than the ones experienced by northern cattle feeders. We now have a negative basis where live cattle futures prices are above live cattle cash prices, but look for cash prices to remain very, very strong and stay very close to futures. The cash market is where we see the overall impact of our greater economy take shape. There is an interesting dynamic going on in the cash cattle market right now as cattle producers are faced with a strong dollar and rising interest rates. Cow-calf operators can and should be celebrating these high prices. Stocker operators and feed yard operators, however, are faced with much different prospects as they look to refill inventory as well as pen space. Sale mixes in the sale barn are skewed heavily towards 6 weights and above, while lightweight calf supplies are very sparse, barely even making truckload size. Feed yards will definitely be targeting heavier weight feeder cattle that will finish earlier than lighter weight feeder cattle and allow them to take advantage of the strong cash market. Stocker operators, unfortunately, will be on the lookout for lighter weight calves that, again, very, very sparse supply. Think anything less than 6 weight. They're going to have a tough time finding them, which just speaks to our tightness in supply. Both of these types of operations, however, will be looking for the cattle markets to beat rising interest rates. Thankfully, for all cattle producers, cutout prices remain very strong. Choice only briefly dipped below $300 last week. As of the AM release today, choice grade meat is at $302.62 and select is at $276.75. Now, to reintroduce our guest, Brandon joins us today from the Feed Foundations team as a fellow risk management advisor for the Feed and Grain team. Brandon, please take us through the funky world of feed.
Yeah, absolutely. So it's been a little bit of a wild ride here the past few weeks, especially as we look at the protein sector, specifically soybeans and soybean meal have really been on quite the decline. We've just continued to drive this thing lower and lower, a little bit to most surprise, right? We've had this balance sheet on soybeans that has just continued to tighten and tighten as we move throughout the summer. There's been a lot of fears on yields. We've continued to have fairly strong demand, not only from an export standpoint, but there's more and more crush capacity coming online throughout the Midwest. So our protein markets, we would expect them to be strong. So we are taking every opportunity we can to try and capitalize on these lower protein prices in terms of our operations as we look to buy protein for the new crop year. And then as we look over to the corn side of things, that market has been very stagnant here the last month. We've just been stuck in a really range-bound trade. Call it between 470 and 490. We haven't really strayed too far out of those territories. And as we look at the quarterly stocks report from last week on Friday, we actually had a little bit of a surprise both on the corn and soybean front. We had corn ending stocks that came in at 1.36 billion bushels versus 1.42 that was expected. That corn number was a lot tighter than most had expected. And vice versa on the soybeans, we actually had soybean ending stock numbers come in at 268 million bushels versus the 242 that were expected. So we ended up with a little bit more of an abundant balance sheet on the soybean side of things in that quarterly stocks report. Now, even though we saw that soybean balance sheet number tick up a little bit, it's still in an extremely tight spot historically. It probably doesn't change things fundamentally long term in too major of a way, both on the corn and soybean front. So that's why we've been trying to take advantage of these prices, specifically on protein, as that balance sheet remains tight, to try and capitalize on some of these lower prices.
Excellent. Thank you very much, Brandon. What is the top 1 to 2 conversations you're having with producers in your area?
Yeah, absolutely. So obviously the last few weeks, harvest has really continued to just ramp up here throughout the Midwest. Guys are going hot and heavy at this point. So the main thing that we're talking with producers about on a daily basis is what are yields actually doing across the Midwest in a lot of these primary growing regions for corn and soybeans, because the question so long this summer was what yields are actually out there. We had such a detrimentally dry start to this crop. A lot of people were concerned that yields were going to be down substantially from last year and from average. And so far, we're 23% harvested on corn. Beans are getting further along. And so far, that hasn't been the case, that yields are poor. A lot of folks are saying these yields are better than expected. They're surprising expectations. Now, there's definitely some variability out there. Don't get me wrong. There's areas that certainly did take a hit if they missed some of those key timely rains this summer. But by and large, we're finding that we somehow avoided a disaster from a yield standpoint on a large scale, and that these yield numbers probably are not going to end up being all that bad by the time this thing finishes up. So really, in terms of kind of what that means price-wise on the corn side of things, especially as these yields come in strong, as a lot of you probably know, we have a lot of corn acres out there this year. And with how poor demand has been, it makes our balance sheet quite abundant. Anytime that we're talking a carryout number, an ending stock number on corn, if we look a year down the road that they're expecting to be around 2 billion bushels, it typically signals prices that are not around $5, which is kind of where we've been hovering lately. So barring any sort of big setbacks with the South American growing season, as they really start to get rolling down there right now, especially on soybeans, that's one of the big things to kind of keep an eye on, is how that crop progresses, how planting progresses down there. And barring any setbacks with the South American crop, either from a planting perspective or just from a sheer crop progress perspective, there's opportunity for this corn market to potentially move lower, which is at a benefit to us livestock producers needing to purchase in this feed.
Right. Yeah. Coming from a corn deficient area in the Texas Panhandle, there are Texas cattle feeders, Texas cattle producers that the main topic of conversation are the current harvest numbers coming out of the Midwest. Cattle producers down here, where we buy in a lot of corn, a lot of grain, truthfully are very pleased with some of the corn harvest yields that we're seeing coming out of the Midwest. Second thing that I would say is top of mind down here is in the Texas and Oklahoma panhandles specifically, we're starting to chop silage, and thus far silage yields seem to be coming in around average, maybe a little lower, maybe a little higher, depending again where producers are in those regions.
Yeah, I agree with you, MT. It seems like that seems to be the sentiment across the country. And, in terms of us from a livestock production side of things, we know kind of where our revenue streams are at right now with these cattle markets being as elevated as they are despite some of these recent pullbacks. So a lot of folks right now are saying, hey, I've got really strong cattle prices. I know I can manage my revenue side of things via different tools like LRP, options, what have it. So a lot of them now are saying, what can I do on my feed input side of things to make sure I'm not just managing my revenue, but I'm managing my margin by way of my largest expense in feed. So something we'll continue to have conversations on, and definitely something to be prudent and proactive in managing as we kind of walk forward and start planning out into 2024.
Thank you so very much for joining us today, Brandon. That is a wrap for this episode of Pasture to Pen. Thank you to all of our viewers for watching this episode. If you have not done it yet, hit the like button, hit the subscribe button, and click the bell to be notified of future episodes. Thank you once again to my guest, Brandon. Thank you. A big thank you to Paige, who always helps us look our best. Another big thank you to Corey, Hattie, and the entire EverAg Insights team for making this show a reality. Until next time, stay safe, pray for rain.